Now, high yield option income ETFs have exploded in popularity over the last few years, with investors flocking towards funds like ULTY, the YieldMax Ultra Option Income Strategy ETF, for their ability to generate weekly distributions. And unlike traditional ETFs that pay quarterly, such as SCHD, ULTY sends income every single week, making it very appealing to those who love predictable cash flow. And especially since many of these funds have very high distribution rates, it seems like you're getting a sizable paycheck. Now in this video, I'll walk you through the distributions that I've received from ULTY and explain how I manage reinvestment and highlight the real risks and rewards of a fund like this for income. So without further ado, let's go into our ULTY position. We still have 1,500 shares at an average cost of about $6.02. And as we can see, we have a market value of negative 6.76%. And that is the main reason a lot of people have been selling ULTYs of recently and questioning how good is this fund. But the total return, not this one, this is just share price only, the total return with distributions collected is going to be the real indicator. And if we head down to the history and sort by our distributions, we can see we've been getting weekly payouts week over week, with the distribution amounts increasing as we've increased our shares over time. And I've compiled it into a spreadsheet right here that shows all the distributions that I've received so far since May 30th, with our first distribution being $28.62. Now, as we can see, it's slowly climbed up to over $100 per week, which is absolutely amazing, giving us a total of $1,042.95 in total distributions. And this is just a few thousand over just 3 months. So keep in mind, this is from weekly income, not long-term capital gains or stock appreciation. But it's important to note how these distributions have been generated, and that is going to be the underlying strategy of ULTY. So you definitely want to check out their holdings. We can see that in their prospectus, it's going to hold between 15 and 30 high volatility US stocks, which are going to be mainly huge tech names and very speculative companies in order to get that high implied volatility. Because remember, with the higher implied volatility you have, you're going to have higher distribution rates because you're generating option income from selling call options and other securities. Now, if ULTY was to hold some safer stocks and companies, then we wouldn't see the high distribution rate that many investors, income investors, know and love. But that also comes with some downsides, which we'll go into later in this video. And it's very important to not ignore that there are risks involved with this ETF. So including all of the distributions, which was $1,042.95, we can actually see we're positive total return, even though we are down about $600. So we're positive about $400 since May, which is pretty good for this type of investment. And it shows that you're not really losing money. You do have to hold it a bit to generate those distributions. And if you can, buy on the dips to get even more shares at a lower cost basis. And as we can see, I have 1,500 shares. I'm not automatically reinvesting back into this ETF from every single distribution. What I'm doing is I'm noticing what the share price is going to be. And then if I see it's at a low point, I will slowly add some more shares of ULTY to increase my share count, which in turn is going to increase my weekly distributions. And in addition to allocating some of those distributions to ULTY, I am also adding it to other positions, mainly QQQI, which is the NEO's NASDAQ 100 High Income ETF, famous for its stable NAV and its 14% monthly distribution. And in my opinion, QQQI has been one of the most stable performers in my portfolio, and it's something you can really rely on. And it's won an award from ETF.com Best New ETF of 2025 for a good reason. It's been performing absolutely well, even though the share price is only 4% since inception of February of 2024. You are getting that 14% distribution, so the total return is actually much higher. And we can see there's tons of articles. What is the catch with ULTY's 89% dividend? Is it real? And we can see the key points are ULTY has real dividends, but capital depreciation has made for rather modest total returns. So you're not going to be getting 89% return every single year. There is going to be possibly some share price depreciation that we are going to see with ULTY, as we have in the past month. It's down 6%. And that is because some of these holdings have dropped in price. A lot of people are saying there's NAV erosion, but that may not be the case. Now, there is going to be some erosion, especially since it has a very high expense ratio of 1.30%, which is going to eat away at the NAV. But we actually see we have some of these holdings that are down in the past month, which in turn is going to drop ULTY in share price as well. And because it is a covered call ETF to generate those weekly distributions, you're not going to really see much share price appreciation when the underlying assets that ULTY is holding goes up in price. And that is part of the trade-offs that we have been talking about. There is limited upside potential because it's selling covered calls, and any big rallies in the underlyings are going to be capped. You're not going to see those gains, and you would have been better off buying the underlying asset. But that's not why we buy ULTY. We buy it because of a purely income strategy. But you do have to note that you do have the full downside exposure if the underlyings end up dropping. Now, this ETF does have new protective puts in place. So if some of the underlyings, so let's say Robinhood Markets stock drops 90%, ULTY isn't going to feel that whole drop. It's going to have some protective puts in place, and it's only going to help with the drop a little bit. And with this article, we can see that even though ULTY shares are plunging, the yield, the distributions completely make up for it, especially if you're reinvesting those distributions. But in my opinion, ULTY has been performing as expected. We have received lots of distributions week over week, and I'm comfortable holding ULTY because of that weekly cash flow as well as high distribution rate, giving me double-digit income and making a strong cash flow vehicle. Now, we also have the flexibility because we're getting weekly distributions. We can redeploy the distributions into other ETFs or use them for expenses or of course, buying more shares of ULTY. I do plan to expand and buy more shares of ULTY, but I'm also adding to other positions as well. And the key takeaway is that I received $1,042.95 in distributions from ULTY in about 3 months. I do not auto drip. I prefer manual reinvestment. And overall, total returns do matter, not just the yield, because you're getting the income plus price performance, which is going to give you the true picture. You can't base it off of the share price depreciation alone. A lot of people have bought in at a pretty high time. I know a lot of people bought in at $6.40 and then seeing their ETF drop all the way to $5, mid $5 range has not been too great for those people. But if you're patient enough, I do think that we will see some bull rallies later, which will help create that NAV stability as we've seen for the past few months. And that's why ULTY has become so popular in the past few months as well. And we also want to note that ULTY does not inherently suffer NAV erosion. The price drops that you're seeing completely mirror the underlying basket of stocks. And the nice bull rally that we had in the past 3-4 months was because a lot of the underlyings that ULTY chose had gone up on severe bull rallies, which in turn has made a huge total return for ULTY investors. And to reiterate, the risks with this ETF include the capped upside potential. Even though the share price does appreciate a little bit during these bull rallies, it's not going to appreciate in the manner that the underlying stocks are. Because if we say all of the holdings go up 100%, this ETF is not going to go up 100% to $10. It'll likely go up to maybe $6, $7, but because the covered calls cap the upside potential, you're not going to see that capital appreciation, and that is not a good reason to invest in something like this, which is focused on purely income. So overall, ULTY is not for everyone. If your goal is growth, you'll be disappointed because the covered call strategy prevents much capital appreciation. But if your goal is weekly income and you understand the risks, ULTY can play a powerful role in a cash flow oriented profile. Now, with over 1,000 distributions collected, I see firsthand how consistent the income is, and for me, the key is managing reinvestment manually, keeping an eye on total return, and remembering that ULTY is an income tool, not a long-term growth engine.